The title of this week's audio blog is Goldman takes central bank credibility to an all-time low and gold cartel vulnerability to an all-time high. Now, after the epic must-listen podcast I did with Greg Hunter, Kerry Lutz, and Future Money Trends in the past 48 hours, the former two of which have already been published, I didn't plan on scripting an audio blog this morning. However, I was spurred into action by the unfathomably egregious cartel attempts, thus far as unsuccessful as they've been annoying, to prevent precious metals' momentous upside breaches of their respective 5.5-year downtrend lines from holding. Not to mention their 200-week moving averages, which, while gold remains well above this level, currently at roughly $12.40 per ounce, silver is mere pennies below its cartel-orchestrated but doomed to imminently fail trendline level of $17.75 per ounce. This amidst one of the most PIMBEEB, or precious metal bullish, everything else bearish, headline environments in memory, culminating for now with this morning's pathetic ECB announcement and Goldman Mario Draghi press conference, which I'll get to momentarily. Regarding the epic PIMBEEB headlines, which are becoming as ubiquitous as the negative interest rates Europe has been imprisoned with for 3 years, with the prospect of, quote, remaining at their present levels for an extended period of time, Zero Hedge put it best in stating, the day before Berserker Thursday, with its UK elections, Comey testimony, and the ECB decision, was supposed to be quiet. Instead, we had the first domestic Iran terrorism in decades, Iran vowing revenge on Saudi Arabia, rising Qatar crisis tensions, South Korea telling the U.S. it can go to hell, Syria threatening to strike U.S. forces, the biggest crude oil crash in months, Germany pulling out of Turkey, and Turkey approving the deployment of troops to Qatar. And now, to top it all off, moments ago, North Korea fired not one, but multiple ballistic missiles. Amidst all this, including the CRB commodity index breaking below major support, going all the way back to the height of the oil crash in early 2016, the Dow Jones propaganda average closed higher in prototypical dead ringer form, whilst precious metals were subjected to paper raids at essentially every key attack time. Particularly the 12 o'clock p.m. cap of last resort, when after briefly turning positive after oil prices crashed, and I do mean crashed, following an historically ugly Department of Energy inventory report, gold was magically capped by a prototypical cartel herald algorithm when gold hit a new 2017 high of $1,295 per ounce. And silver had come within 3 cents of its 200-week moving average of $17.75 per ounce, before being smashed down through the day's end. One of the, quote, reasons proffered by the mainstream media's anti-gold webbots for precious metals' unexpected decline was headline algos from unnamed sources that the ECB planned to raise its inflation forecast at the following day's, i.e. today's, policy-setting meeting, in what was being spun as a hawkish turn for a central bank that has QE'd more than $1.2 trillion in the past 14 months alone, taking its balance sheet to a Fed matching $4.5 trillion, whilst maintaining negative interest rates for an incredible 3 years. Why such a change would be gold bearish is beyond me, particularly if, like the Fed is famous for, such hawkish statements are not followed up by actual actions. But then again, in a world where the only thing preventing the reality of the economic and monetary collapse that has already decimated countless second and third world nations from hitting the so-called first world like a tidal wave is relentless, unprecedented market manipulation. Anything central bankers like Goldman Mario say are interpreted as bad for gold, good for bonds, and great for stocks. As it turns out, not only did the ECB not raise its inflation forecast, which I knew they wouldn't, given that oil prices are free-falling, more on that in a moment, and the euro has been rising due to historically misplaced relief that Marine Le Pen lost and plunging expectations for U.S. economic activity, but he in fact lowered inflation expectations by a significant amount, which is probably why the euro subsequently plunged, demonstrating, per my series of If a Nuclear Bomb Destroyed Europe articles, why the level of the dollar index, which in essence is simply a proxy for the euro-dollar exchange rate, has been, and will continue to be, completely and utterly useless as a predictive measure for gold and silver prices. But again, more on that in a moment. Back to said biggest crude crash in months, how much more vindicated can I be than for my relentless, vigorous claims that the OPEC production cut deal, and with it potentially OPEC itself, would miserably fail? pretending well for precious metal longs, who feel the cartel is preventing their rightful gains via the same type of historic manipulation that for the past 18 months prevented crude oil shorts from their rightful gains by the oil PPT that was launched, headed by the U.S. government, I bet, to support their terrorist ally Saudi Arabia. To wit, my article last week titled, OPEC, like the London Gold Pool, proving that cartels always fail. To that end, since the May 25th announcement that said production cut agreement, which after 6 months has had essentially zero impact on historically high global oil inventories, was extended an additional 9 months, prices have free-fallen from a hyped-up $52 a barrel the day of the announcement to a low of $45.30 per barrel this morning. Yesterday's shockingly huge Department of Energy published crude oil, gasoline, and distillates inventory builds were the cherry on an historically bearish oil cake. Mere hours after the unfathomably out-of-left-field news that Saudi Arabia had essentially declared war on fellow OPEC member Qatar for, I kid you not, sponsoring terrorism? How they came to this conclusion and why it necessitated a financial, economic, and naval blockade is beyond me. However, when one considers that Qatar shares one of the world's largest natural gas fields with Saudi Arabia's increasingly mortal enemy, Iran, the story takes a decidedly different twist. Throw in the fact that one day later, i.e. yesterday, the first ever terrorist attack on Iranian soil is being claimed by ISIS but blamed on Saudi Arabia by Iran. And you can see just how potentially dangerous the world's most dangerous geopolitical hotspot is about to get. Not to mention, America not only bombed Syria for the third time yesterday, prompting Syrian forces to promise a significant counterattack, but is being partially blamed by Iran for the aforementioned terrorist attack, given that just last week Donald Trump was visiting Saudi Arabia and condemning Iran's terrorist leanings. For the millionth time, I cannot understate the fact that the energy industry has more jobs, debts, many of them of the junk variety, sovereign currencies, and political regimes dependent on it than any other without peer. And now that the historic and potentially irreversible for a variety of secular reasons, glut is reasserting itself, despite OPEC and the oil PPT's best efforts, the potential negative ramifications on the global political, economic, social, and perhaps military and monetary fronts are as incalculable and potentially imminent as any other threat the world currently faces. Consider, for instance, the Iranian terrorist attack, Qatari-Saudi Arabian rift, and the fact that Goldman actually specifically cited plunging oil prices as the reason for reducing the ECB's inflation expectations, thus prolonging Europe's NERP and QE nightmares, pushing the euro one step closer to the hyperinflation that will inevitably destroy it. Before I get back to the ECB and the historic credibility loss it brought upon itself today, via hubristic arrogance that Julius Caesar himself would blanch at, and a Keynesian cluelessness Ben Bernanke and Janet Yellen would applaud. Consider that today, per Zero Hedge's comments above, is supposedly a triple threat of major news events, i.e. the ECB meeting, James Comey's long-awaited congressional testimony, and the UK election, which is ongoing as I speak. Regarding the former, it's difficult to believe anyone without an agenda or propaganda assignment could actually believe the ECB would say, let alone do, anything hawkish, given how fragile the global economy and European political environment have become. Not to mention, with oil prices plunging and the euro rising, both of which are net negative for global trade, inflation expectations, and geopolitical stability. As for Comey's testimony, which is in session as I speak, I can't imagine how anyone can expect anything material to come of it, given that not only have multiple insiders spent the week saying Comey would say nothing damning about Trump's actions, but his prepared remarks were actually released yesterday. And as for the UK election, without being an expert on the topic, it doesn't appear likely that anything significant will come of it, like, for instance, a dramatic loss of support for Theresa May's Conservative Party. I mean, May herself called for early elections, and no one is expecting a material change in the status quo. Thus, I ask, exactly what is so important about this election in the first place? More important than such fabricated threats, in my view, propagandized as such, principally to aid market manipulation efforts, particularly in precious metals, given their historic technical breakout attempts, are the real threats of plunging oil prices, surging personal and corporate bankruptcies, Anthem Health dropping Obamacare, which I must remind you is not being repealed or replaced anytime soon, in Ohio, leaving hundreds of thousands of people without 2008 insurance options, consumer credit rising at its lowest rate in 6 years, The fact that neither significant tax cuts nor infrastructure spending boosts have even been proposed, let alone debated, an historic debt ceiling crisis mere weeks away, and oh yeah, U.S. economic data is plunging to the point that future markets no longer think a September or December rate hike is likely. To that end, there still remains a nearly 100% expectation of a rate hike at next week's FOMC meeting. Not because the Fed should take the moronically stupid step of rising rates into a collapsing economy, but because the clueless Keynesian morons on said committee have cried wolf once too often. To that end, you can take it to the bank that this increase, finally after more than a decade, bringing the Fed funds rate back to a measly 1%, will be the last, before inevitably the recession and or market plunge they will blame on everything and everyone but themselves, just as the ECB did this morning, will force them to lower rates anew and eventually launch QE4. On to today's main event, i.e. the ECB meeting which, in my view, was a non-event from the get-go. In other words, given the horrific overall condition of the European Union, amidst a global economy in accelerating decline, plunging commodity prices, historically ominous geopolitical instability, as pigs like Italy, Spain, and Greece teeter on the abyss, why would anyone expect significant, incrementally hawkish commentary is beyond me. Let alone, as noted above, hollow words unsupported by actual actions. Oh, and did I mention that just yesterday, the sixth largest bank in Spain, Banco Popular, was both bailed in and bailed out, destroying all of the company's equity and debt value in the blink of an eye. When, as when Bear Stearns was taken over for pennies on the dollar by JP Morgan, with all Bear Stearns' losses guaranteed by the Fed, Popular was taken under for the princely sum of €1. Not €1 per share, but €1. By the equally insolvent Banco Santander, with full backing of the ECB. To that end, even I was floored by just how comically transparent, moronic, and credibility draining the boilerplate ECB policy statement changes were. Or should I say change, given that Goldman, Mario, and friends one-upped even Whirlybird Janet herself in changing just 3 words from last month's policy statement. And 3 very important words they were, which I say facetiously, given how Wall Street and their fake news partners in the MSM have pretended to be momentous, when in fact they were completely meaningless. Which was, drumroll please, to change the Governing Council expects the key ECB interest rates to remain at their present or lower levels for an extended period of time and well past the horizon of the net asset purchases, to the Governing Council expects the key ECB interest rates to remain at their present level for an extended period of time and well beyond the horizon of the net asset purchases. If you even caught the difference, the only change from a month ago was to say the ECB now expects its negative 0.4% interest rate, i.e. the lowest rate any central bank has ever gone, without peer, to remain in place ad infinitum, instead of ad infinitum with the chance of being taken still lower. Moreover, the inflation expectations, which, like the Fed, the ECB believes it can forecast to the 0.1% over a multi-year period, despite having been wrong about everything they've ever predicted, that were trial ballooned as likely to be raised, were in fact dramatically reduced from 1.7% to 1.5% in 2017, 1.6% to 1.3% in 2018, and 1.7% to 1.6% in 2019, i.e. percentage declines of 12%, 19%, and 6% respectively. And listening to Goldman Mario's press conference thereafter, it truly felt like I was listening to Whirlybird Janet herself, or Mark Carney, Haruhiko Kuroda, or any major central bank head, given that all they say and do is the exact same world-destroying, currency hyperinflating things, i.e. he blamed everyone and everything but the ECB itself for the fact that its historic NERP and QE programs will continue ad infinitum, such as, to name a few, global economic developments, falling oil prices, and my all-time favorite central banker cop-out, the slower-than-expected rollout of European Union structural reforms. Subsequently, I kid you not, gold prices plunged, as if the widely unexpected dovishness was a bad thing for the only real money the world has ever known. This as the euro plunged, as well as crude oil prices, while stock and bond futures barely budged from yesterday's closing levels. But the coup de grace of manipulation blatancy didn't come until an hour and a half later, when, mere minutes before the cartel's historic key attack time number 1, i.e. 10 o'clock a.m. Eastern Standard Time, when the London Fix ends global physical trading for the day, quote, someone dumped $4 billion of notional paper gold on the COMEX, taking prices nearly instantaneously from $12.83 an ounce to $12.72. What do you know, below the 5.5-year downtrend line at $12.74 per ounce. World's paper silver was, as usual, smashed in sympathy to the tune of 32 cents an ounce, or nearly 2% in a matter of minutes, with no other market materially budging, i.e. a prototypical, blatantly orchestrated cartel paper raid as we observed tens of dozens of times before. In other words, a transparently coordinated attack to get the cartel through the dovish ECB statement, just as was the case on December 7, 2011, when after the ECB unexpectedly lowered rates, prompting a gold surge that threatened to negate the price damage caused by September 5, 2011's historically blatant Operation PM Annihilation 1 raid on Labor Day Eve, mere hours after the ultra-precious metal bullish news that the Swiss bank was pegging the franc to the euro. Gold prices were equally paradoxically attacked at 10 a.m. Eastern Standard Time to prevent said, in what I call the Operation PM Annihilation 2 attack, to prevent said damage from being undone. To the point that the cartel actually circulated headlines back then to the top media newswires, afterwards retracted without comment, that the Bank of International Settlements, Federal Reserve, and Bank of England were selling gold at the highs to cap prices. Like that attack, this one, which as I write is already unraveling, given that gold has just re-breached its 5.5-year downtrend line to the upside, will dramatically fail, likely sooner rather than later, given the historic PIMBEEB environment, which promises to become more so with each passing day. Consequently, the opportunity afforded by the past 2 days' cartel desperation raids to prevent precious metals' inevitable, perhaps spectacular breakouts above their respective 200-week moving average and 5.5-year downtrend lines is as potentially lucrative as any I can recall. And given that precious metals' chief use case is the protection of wealth in the face of money printing and draconian government actions, never before, per the title of my article earlier this week, has history's best financial insurance been so dirt cheap. To that end, the need to protect yourself from what's coming, financially and otherwise, has never been more urgent. And if your desired protection prescription is precious metals, particularly if you seek the best possible storage options, we humbly ask you to call Miles Franklin at 800-822-8080 or go to milesfranklin.com and register for online purchasing and give us a chance